Good, good morning to Madam Sasha. Today my group is going to present on MFRS 16, leases, the theory behind it and the issues. Today my group is me, Zakwan, Atira and Kai. So the reason we use leases because we want to gain an access to asset or obtaining finance and reducing the entity exposure to the risk of asset ownership. The prevalence of leasing means that it is important that user of financial statement have a complete and understandable picture of entity leasing activities. So the objective of leasing is to ensure that lessees and lessors provide relevant information in a manner that faithfully represent those transactions. This information gives basis for user of financial statement to assess the effect that leases have on the financial position, financial performance and cash flow of an entity. And the scope of lease is should apply to all except for these, which are leases to explore for used mineral, oil, natural gas, leases for biological assets, service concession under interpretation 12, licenses of intellectual property and rights held by lessee under licensing agreement within the scope of MFRS 138 intangible assets. So the lease term is for an entity should determine the lease term as the non-cancelable period of lease together with both periods covered by an option to extend the lease if the lessee is reasonably certain to exercise the options. Periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise the options. In assessing whether a lessee is reasonably certain to exercise an option to extend a lease or not to exercise an option to terminate a lease, an entity should consider all relevant facts and circumstances that create an economic incentive for the lessee to exercise the option to extend the lease or not to exercise the option to terminate the lease. A lessee also should reassess whether it is reasonably certain to exercise an extension option or not to exercise an termination option upon the occurrence of either a significant event or a significant change in circumstances that is within the control of the lessee, or it affects whether the lessee is reasonably certain to exercise an option not previously included in its determination of the lease term, or not to exercise an option previously included in its determination of the lease term. An entity also should revise the lease term if there is a change in the non-cancelable period of a lease. For example, the non-cancelable period of the lease will change if the lessee exercise an option not previously included in the entity determination of the lease term, such as MFRS 16, and the lessee does not exercise an option previously included in the entity determination of the lease term. Next, I will give to Atira.
I will explain about the leasing part. First is recognition. At the commencement date, lessee should recognize a right of use of assets and a lease liability. Second is about the measurement. First is the initial measurements. At the commencement date, a lessee should measure the right of the use at cost. The cost of the right of use asset should comprise A. The amount of the initial measurement of the lease liability. B is any lease payments made at or before the commencement date less any lease incentive received. C is any initial direct cost incurred by the lessee. D, an estimate of cost to be incurred by the lessee in dismantling and removing the underlying asset, restoring the site on which it is located, or restoring the underlying asset to the condition required by the terms and conditions of the lease, unless those costs are incurred to produce the inventories. Initial measurement of the lease liability. At the commencement date, a lessee should measure the lease liability at the present value of the lease payments that are not paid at that date. The lease payment should be discounted using the interest rate implicit in the lease if that rate can be readily determined. If that rate cannot be readily determined, the lessee should use the lessee incremental borrowing rate. At the commencement date, the lease payment included in the measurement of the lease liability comprise the following payments for the right to use the underlying asset during the lease term that are not paid at the commencement date, such as A. Fixed payment less any lease incentive receivable. B is variable lease payments that depend on index or rate, initially measured using the index or rate as the commencement date. C. Amounts expected to be payable by the lessee under residual value guarantees. D is the exercise price of a purchase option if the lessee is reasonably certain to the exercise the option. And E. Payments of penalties for terminating the lessee if the lease term reflects the lessee exercising an option to terminate the lease. Second is the subsequent measurement. After the commencement date, a lessee should measure the right of use asset applying a cost model unless it applies either of the measurement models. Third is the cost model. To apply a cost model, a lessee should measure the right of use asset at the cost. A. Less any accumulated depreciation and any accumulated impairment loss. And B. Adjusted for any measurements of the lease liability specified in paragraph 36C. Subsequent measurement of the lease liability. After the commencement date, a lessee should measure the lease liability by A. Increasing the carrying amount to reflect interest on the lease liability. B. Reducing the carrying amount to reflect the lease payments made. And C. Remeasuring the carrying amount to reflect any reassessments or lease modifications specified in paragraph 39 until 46 or to reflect revised in substance fixed lease payments. After the commencement date, a lessee should recognize in profit or loss unless the costs are included in the carrying amount of another asset applying other applicable standards, or both A. Interest on the lease liability, and B. Variable lease payments not included in the measurement of the lease liability in the period in which the event or condition that triggers those payments occurs. For lease modifications, a lessee should account for a lease modification as a separate lease if both A. The modification increases the scope of the lease by adding the right to use one or more underlying assets, and B. The consideration for the lease increases by an amount commensurate with the stand-alone price of the increase in scope and any appropriate adjustments to that stand-alone price to reflect the circumstances of the particular contract. Okay, for the presentation of a lessee should either present in the statement of financial position or disclose in the notes. A. The right of the used asset separately from the other assets. If a lessee does not present right of use asset separately in the statement of financial position, the lease shall include the right of use asset within the same line item as that within which the corresponding underlying asset would be presented if they were owned, and 2. Disclose which line items in the statement of financial position include those right of use assets. B. Lease liabilities separately from other liabilities. If the lessee does not present lease liabilities separately in the soft P, The lessee should disclose which line items in the SOFI include those liabilities. Okay, in the statement of the cash flow, a lessee should classify A. Cash payments for the principal portion of the lease liability within the financing activities. B. The cash payments for the interest portion of the lease liability, applying the requirement in MFRS 107 statement of cash flows for the interest paid. And C is the short-term lease payments for leases of low value assets, and variable lease payments not included in the measurement of the lease liability within the operating activities. Okay, last is disclosure. The objective of disclosure is for lessees to disclose information in the notes that, together with the information provided in the SOFI, in the statement of profit or loss and statement of cash flow, give a basis for users of financial statement to assess the effect that lessee have on the financial position, financial performance and cash flow of the lessee. Lessee should disclose the following amounts for the reporting period. A. Depreciation charge for right of use assets by class of underlying asset. B is the interest expense on lease liabilities. C is the expense relating to the short-term leases accounted for applying paragraph 6. This expense need not to include in the expense relating to the lessees with a lease term of 1 month or less. D is the expense related to.
Now, I'm Guy. I will continue with the lessor. A lessor shall classify each of its leases as either an operating lease or a finance lease. A lease is classified as a finance lease if it transfers substantially all the risks and rewards incidental to ownership of an underlying asset. A lease is classified as an operating lease if it does not transfer substantially all the risks and rewards incidental to ownership of an underlying asset. Next is example of the situation that individually or in combination would lead to a lease as a finance lease are: A. The lease transfers ownership of the underlying asset to the lessee by the end of the lease term. B is the lessee has the option to purchase the underlying asset at a price that is expected to be sufficiently lower than the fair value at the date the option becomes exercisable for it to be reasonably certain at the inception date that the option will be exercised. Next, C is the lease term is for the major part of the economic life of the underlying asset, even if title is not transferred. D is at the inception date, the present value of the lease payment amount to at least substantially all of the fair value of the underlying asset. E is the underlying asset is of such a specialized nature that only the lessee can use it without major modification. Indicators of situations that individually or in combination could also lead to a lease being classified as a finance lease are: A. If the lessee can cancel the lease, the lessor's losses associated with the cancellation are borne by the lessee. B is gain or losses from the fluctuation in the fair value of the residual accrued to the lessee. C is the lessee has the ability to continue the lease for a secondary period at a rent that is substantially lower than the market rent. Next is finance leases. Recognition and measurement. At the commencement date, a lessor shall recognize assets held under a finance lease in its statement of financial position and present them as a receivable at an amount equal to the net investment in the lease. Next is initial measurement. The lessor shall use the interest rate implicit in the lease to measure the net investment in the lease. In the case of sublease, if the interest rate implicit in the sublease cannot be readily determined. An intermediate lessor may use the discount rate used for the head lease to measure the net investment in the sublease. Next is manufacturer or dealer lessor. At the commencement date, a manufacturer or dealer lessor shall recognize the following for each of its finance leases. A. Revenue being the fair value of the underlying asset, or if lower, the present value of the lease payment accruing to the lessor, discounted using a market rate of interest. B is the cost of sale being the cost or carrying amount if different of the underlying asset less the present value of the unguaranteed residual value. C is selling profit or losses, being the difference between revenue and the cost of sale in the accordance with its policy for outright sales to which MFRS 15 applies. Next is subsequent measurement. A lessor shall recognize finance income over the lease term based on a pattern reflecting a constant periodic rate of return on the lessor net investment in the lease. A lessor aims to allocate finance income over the lease term on a systematic and rational basis. A lessor shall apply the lease payment relating to the period against the gross investment in the lease to reduce both the principal and the unearned finance income. A lessor shall apply the derecognition and impairment requirements in MFRS 9 to the net investment in the lease. A lessor shall review regularly estimated unguaranteed residual value used in computing the gross investment in the lease. If there has been a reduction in the estimated unguaranteed residential value, the lessor shall revise the income allocation over the lease term and recognize immediately any reduction in the respect of amount accrued. Next is lease modification. A lessor shall account for a modification to a finance lease as a separate lease if both: A. The modification increases the scope of the lease by adding the right to use one or more underlying asset. B is the consideration for the lease increased by an amount commensurate with the stand-alone price for the increase in scope and any appropriate adjustment to that stand-alone price to reflect the circumstances of the particular contract. For a modification to a finance lease that is not accounted for as a separate lease, a lessor shall account for the modification as follows. A is if the lease would have been classified as an operating lease had the modification been in effect at the inception date, the lessor shall account for the lease modification as a new lease from the effective date of the modification. And B, measure the carry amount of the underlying asset as the net investment in the lease immediately before the effective date of the lease modification. B is otherwise the lessor shall apply the requirements of MFRS 9. Next is operating leases. Recognition and measurement. A lessor shall recognize lease payment from operating leases as income on either a straight line basis or another systematic basis. The lessor shall apply another systematic basis if that basis is more representative of the pattern in which benefit from the use of the underlying asset is diminished. A lessor shall add initial direct costs incurred in obtaining and operating lease to the carrying amount of the underlying asset and recognize those costs as an expense over the lease term on the same basis as the lease income. The depreciation policy for depreciable underlying asset subject to operating leases shall be consistent with the lesser normal depreciation policy for similar asset. A lessor shall calculate depreciation in accordance with MFRS 116 and MFRS 138. The lease modification. A lessor shall account for a modification to an operating lease as a new lease from the effective date of the modification, considering any prepaid or accrued lease payment relating to the original lease as part of the lease payment for the new lease. The presentation, lessor shall present underlying assets subject to operating lessors in its statement of financial position according to the nature of the underlying asset. Now we'll pass to Zakwan to continue.
So what is a sale and leaseback transaction? Sale and leaseback transaction is when the lessee, which the seller, transfer an asset to another entity, the buyer, or we call lessor, and leases the asset back from the buyer. Both the seller, lessee, and the buyer, lessor, should account for the transfer contract and the lease. If the transfer of an asset by the seller, lessee satisfy the requirement of MFRS 15, or as the sale of the asset, the seller shall measure the right of use asset arising from the leaseback at the proportion of the previous carrying amount of the asset that relates to the right of use retained by the seller. Accordingly, the seller shall recognize only the amount, any gain or loss that relate to their rights, and transfer to the buyer. The buyer should account for the purchase of the asset applying applicable standards, and for the lease applying the lessor accounting requirement in this standard. If the transfer of an asset by the seller does not satisfy the requirement of MFRS 15, it does to be accounted for a sale of the asset. So it's not a transfer. So the transfer of the asset is not a sale. The seller or lessee should continue to recognize the transfer asset and shall recognize a financial liability equal to the transfer proceed. It should account for the financial liability applying MFRS 9. The buyer, lessor, shall not recognize the transfer asset and shall recognize a financial asset equal to the transfer proceeds. It shall account for the financial asset applying MFRS 9. So the issue for MFRS 16 leases is to identify an abandoned lease by distinguishing between lease and non-lease component and allocating a consideration amount for each component according to observable prices or information. It will be challenging, as example, separating a lease component from bundle services arrangement involving an asset. And we also need to treat the multiple lease elements as a single lease, and then weigh the impact of having a bigger balance sheet versus the accounting complexity of separating the lease and non-lease components. The next issue is when restructuring business, we need to take into account the business risk and potential costs. And then we require judgment as the measurement process can be complex for the following, such as lease incentive, initial direct cost incurred, estimated cost for dismantling, removal and restorations, lease payment, lease term and discount rate. And additional information for MFRS 16, the lessee will apply a single accounting model for all lessees with limited exceptions and replaces existing accounting standard, which are MFRS 117. And it's a full retrospective or modified retrospective approach, and options for certain transitional relief are also available. MFRS 16 will be effective for annual period beginning on or after 1st January 2019. Thank you. That's all from us. Thank you.